Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the degree of operating leverage, degree of financial leverage, and combined leverage. This is going to be part 2 of our practice problem. Last time we focused in on the degree of operating leverage. We're going to move on and mainly focus on the degree of financial leverage here, and then we'll have the combined leverage, which will be a relation between the two. If you haven't seen the prior presentation, probably want to take a look at that one first. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 520 degree of operating leverage, degree of financial leverage, and combined leverage tab in the practice problems section. Closing this back out. Now, we started this problem in a prior presentation focusing in on the degree of operating leverage. So we're going to be a ways down if you're working with this OneNote presentation. We're going to scroll a bit down to get to it. If you've missed the prior presentation, you probably want to take a look at that first. So we have the income statement here that we use. This is a contribution margin format income statement as opposed to a normal income statement taking sales minus variable costs, giving us the what would be the contribution margin minus the fixed cost, as opposed to sales minus cost of goods sold, giving us the gross profit. So we used this information to think about our first leverage calculation, degree of operating leverage, and we did that for our first scenario, and we also considered what would happen if there was an increase in sales, what would happen to the increase in the operating income. We also looked at a difference if we adjusted the amount of fixed assets or fixed costs versus the variable costs, because that's what the degree of operating leverage is focusing in on. So now we're going to scroll all the way down here. We're going to be focusing in on the degree of financial leverage now. Now, this kind of focuses in where most people think of when you think of leverage. When you think of leverage, you're typically thinking of some kind of debt, some kind of financing, and how leveraged the firm is with relation to that. That's kind of where the focus will be here. There's two formulas we can do for this. The one we'll focus in on is the earnings before interest and taxes divided by the earnings before taxes. Now, this is one that you will typically be able to find whether you're internal to the company, whether you will be using a contribution type margin income statement as the one we are using here, or external to the company, or using, for whatever reason, the normal income statement. You should be able to find basically this information. But you can also do the calculation with the percent change in net income divided by the percent change in the earnings before interest and taxes. We're going to be focusing in on this second line item. Now, if you look at where these line up in terms of the income statement, we've got earnings before interest and taxes, which is oftentimes basically the operating income here. And then we have the interest being broken out, this giving us the earnings before taxes only. And then we would calculate the taxes to give us the earnings after taxes. This bottom half of our income statement would be similar for a normal income statement as the one here, which is basically a contribution margin type of income statement. So fairly straightforward type of calculation. We're going to do our same thing over here where we will have, at the end of the day, the numerator and denominator in the farthest right column, and put this together as like a tax type of worksheet, but it should be fairly straightforward. We're going to start off with the earnings before interest and taxes. That's going to be basically normally kind of like the operating income before we subtracted out the interest, before we subtracted out the taxes. Now, it might be the case that you could be given just basically the net income, and you gotta kind of back into this number. If you were given net income, $296,100, you'd have to add back the taxes, $126,900, plus the interest, $53,000, to get you back up to the earnings before interest and taxes. And then we're going to be taking and comparing that to the earnings before taxes, which we might have to calculate as taking the earnings before interest and taxes, this number, subtracting out the interest, because that's what we're going to be focusing in on. And that's going to give us our earnings before taxes. Now, of course, in our financial statement that we have here, we have that broken out, and you often will have that broken out because the taxes are typically the last thing that you will do in a multi-step income statement. But you might have to back into it depending on the information there. If you had just like the net income and you had to back out the taxes, then you'd say, all right, now I'm going to take the net income, $296,100, back out the taxes, $126,900, and that'll give you your net income before taxes, but after the interest. So the difference between those two numbers is, of course, the interest, and the interest that we're looking at is going to be based on the loan. The interest is kind of like the rent on the loan, which you have to pay for the purchasing power that you borrowed for the loan. And so then if we were to divide this out, then we're going to be taking now the numerator of the 476,000 divided by the denominator 423,000. We get the about 1.3 in terms of our degree of financial leverage. Now, like with our other leverage formulas, if this goes up, then we're going to have more leverage, which could be good or bad, right? It could be bad that it has more risk, but it could be good that it could result in kind of like a multiplier effect in the case where, in the case of good times, as profits are basically increasing. It could multiply the problems if things are going down, going in the negative direction. Now, we'll focus more on that in a future presentation, but just to take a look at that, because we're going to focus in on the degree of operating leverage and the combined leverage here in a second further as we go through this practice problem. But you can see that if the sales were to be increasing, you would have an increase in the earnings before interest and taxes. And as sales go up, then if the interest remains the same, you have the same financing, then you can see there would be less risk, right? There would be less risk involved related to the financial leverage due to the fact that now it's less material in relation to the sales amount. So as basically sales go away from the break-even point, you would expect the degree of financial leverage to be decreasing. So let's do our comparison that we did before to the B scenario, where we kind of using a B scenario to show the impact on the degree of operating leverage, focusing more on the operating leverage because I think that's often more confusing to people. And again, we'll get to the change in financial leverage later. But notice the change in the income statement we had then. We said we're going to have the same earnings before interest and taxes here, but now we're adjusting the cost structure so that we have less variable costs and more fixed costs. That increased the degree of operating leverage. It's not going to have an impact in this case in degrees of the financial leverage because we still have the same amount of interest expense, the same amount of operating income or earnings before taxes, and the same amount of earnings before interest and taxes. So let's just calculate it again based on these numbers because we're going to use this to do our combined leverage as well. We should get to the same outcome, even though we have some different numbers here. We have the earnings before interest and taxes still at that 47.6. We have the earnings before taxes. We can calculate it the same way, the 476,000 earnings before interest and taxes, and then take into consideration the interest to give us the earnings before just taxes, which once again is going to be this number before the taxes, the difference between the two being the interest, the financing on the loans. And if we were to divide those out, we would get to 1.31. So once again, no change, 1.31 here, 1.31 there, even though we had a change just in the cost structure, but there was no change in interest or the operating income. So now let's go down and think about our degree of combined leverage. That we're going to be combining the operating leverage and the financial leverage. Now, there's a couple ways that we can do this. So one way is we can take the operating leverage and multiply it times the financial leverage. We can simply multiply those two together, and we'll get our degree of combined leverage. Or we can take the contribution margin divided by the earnings before taxes, which we'll calculate here. So we'll do both of these two calculations. And then we have the percent change. Now, we're not going to be focusing in on the percent change here or even really much in future presentations because I don't think it's going to be as useful as possibly the percent change in something like the operating leverage, because the operating leverage, if you're not internal to the company, you might need that kind of percent change formula. If you're like an external user and you're using the publicly provided financial statements that are not in a contribution margin format. But the financial leverage calculation, I think you should be able to get either way, and if you multiply the two together, you'll get the degree of combined leverage. So in any case, we'll be focusing in on these top two. So let's do the top one first. We got the degree of combined leverage, which we can calculate as the contribution margin. This is the numerator. We'll recalculate the contribution margin. We've seen it in the past when we did the degree of operating leverage. We're going to take the units, which are going to be 26,000 that we're going to sell, And then we're going to take the contribution margin per unit, which is $72 minus the variable cost of the 36. Contribution margin per unit being 36, then 36 times the 26,000 gives us our contribution margin of the 936,000. That's going to be our numerator. We also could have taken the sales minus the total variable costs, which happens to be half of sales. Don't let that throw you off. It's just you'd have to subtract those two out and you'll get the 936,000. Then we have the earnings before taxes is going to be the denominator, which we're going to be picking up right here. It might also be called operating income. That might be the operating income number as well. We're going to divide that out, the 936 divided by the 423. Remember that you could have rounding here. We always are going to be dealing with rounding. 936,000 divided by the 423,000 is going to give us about 2.21. So about 2.21. So we can also multiply out the degree of operating leverage times the degree of financial leverage and get that amount as well. So in other words, if we take our prior calculations for the degree of operating leverage, degree of financial leverage, bottom line numbers, now these are estimates, so you can make them more exact, but they're going to be about 1.97 times the 1.13, and you're going to get about the 2.21. Again, there's rounding difference, so if you were to subtract, divide these out and take the full number rounded out further, and these rounded out further, you get more exact at the 2.21. And that's why I recommend doing these in Excel as well. So then if we take the second one, so now B, where we had made a change, remember, to B, where the cost structure is now different, although the earnings before interest and taxes is the same, fixed costs being higher and the variable costs now being lower, and that had an impact on the degree of operating leverage, although no impact on the degree of financial leverage. So if we then do our calculation here, we're going to say, all right, let's use these numbers. We've got now the 26,000 times the contribution margin. We're calculating the contribution margin here up top, bottom, the numerator of our formula, the unit price, and now the variable costs are different per unit, now at 20. The 72 minus the 20 is now 52 contribution margin per unit. If we take then the 26,000 times the now 52, we get the contribution margin total, top part of our calculation, the numerator, the 1,342,000. The earnings before taxes is still the same at the 423,000. If we then divide those out, we're going to get about 3.2. So we get the 1352000 divided by the 423,000. We get about 3.20. And then if we were to do our multiplication, once again, we should get the same number if we multiply the operating leverage times the financial leverage. For example, if we had our two calculations for the second part B, and we multiply these two together, we'll get about that 3.2. So let's go ahead and pull out the trusty calculator. We had about 2.84 times about 1.13. That's going to give us about the 3.2. And again, you can make this more exact by saying, okay, if I recalculate this, it's really 1352000 divided by the 476000. It's really more like 2.84033, and then do that here, and then you get a closer number here. And I highly recommend doing this in Excel to do those types of things, so you can work with the rounding that will be involved and do multiple types of calculations. We do work this in Excel as well. Highly recommend taking a look at that. Then we have the break-even analysis, which also kind of ties into this. So you can then work the break-even analysis and see how that will fit into these items as well. Also, just note that, of course, the 3.2 is a higher combined leverage under scenario B than it was at the 2.21 in scenario A. That's what we would expect to happen. The increase in the number means that the leverage is going up, so the combined leverage between operating and financing has gone up due to the fact that the operating leverage went up, due to the fact that there's going to be a increase in the fixed costs in relation to or as compared to the variable costs. No change in the financial leverage due to the fact that there was no change in the net income or the operating income, and there was no change in the interest. Even there was just a change in the cost structure. So if you then take a look at the break-even calculation for these two scenarios, we got the fixed costs here at the 460,000. We have the contribution margin in units, unit price 72 minus the unit variable cost 36 gives us the unit contribution margin of the 36. The 460,000 divided by the 36 is 12,778. That's our break-even point. For the first scenario, if we did the second scenario, we would say the fixed costs are now up to 76,000, and we have the contribution margin in units, our 72 sales price, and the unit variable cost is now only 20. So now we have the contribution margin at 52. 876 divided by that 52 means we would need more units, 16,846, in order to break even. So you can see how this kind of break-even analysis kind of ties into, this is all part of, break-even analysis, break-even calculation here into some of our leverage calculations. And again, it's useful to put this information into Excel, change the data around, and see what the relationships will look like. And if you set up your Excel worksheet properly, where you're pulling this information with formulas, then you can really get some insights on what's going on with them by working with those Excel sheets. Or Google Sheets as well, which is free. So all this stuff should be completely within the capabilities, of course, of Google Sheets as well. So check that out too.